Right, good afternoon or good evening, depending on where you are in the world. My name is Johnny Conran, and I'm managing partner at Joseph Mews. And it's great to be doing our second webinar session of the day today, financing your UK property investment in 2024. So this is the second episode, let's call it, in our series this year. We're going to do one every month, and we're going to be led by you guys in terms of what you want to hear. And it was great after the first one that we did at the end of January that we asked for feedback, and the predominant feedback was asking us to have a bit more information and a webinar based on financing. So whether you're in the UK, whether you're overseas, what your options are, and how we can facilitate that. So that's what we've got for you today. I'm going to be joined by another one of our partners based in the UK, Andrew Siegel. And then we're going to go on to the mortgage expert. So we've got Hitan Galatra, who is Managing Director of Visionary Finance, who's going to be talking to us predominantly about mortgages for clients that are based in the UK. And then we have Sophia Kazmi, who's Managing Director of the Maidwell Group, who's going to be talking to us about mortgaging from overseas. So we have clients, we have offices in Dubai, Johannesburg, Hong Kong, as well as the UK. So we've got clients all around the world, and hopefully the information you get today will incorporate wherever you are. So I'm going to start with a little bit about who we are as a business. Some of you will obviously know who we are, some of you may not. So we'll start there. If we can go to the next slide, please. So our history, we were started by the gentleman on your screen now, Andy Foote, who is our chairman. And he started the business based on the fact that he had had a bad experience himself investing in property. It was off plan, no communication, no transparency, no guidance. And it was all a bit of a disaster. So he said, surely we can make this slightly better. If you're based in the UK or you're based overseas, either one. And so that's what he decided to do. He set up this company, and obviously the track record really speaks for itself. Having been the distribution partner for some big developers in the UK, we've now transitioned into Joseph Mews, where we're partnered with various developers as well as property companies that allow us to access the best stock in the country, and obviously in turn give our investors the best opportunities. So we go to the next slide. We often get asked by clients, why are we called Joseph Mews? And for those of you that know that Mews is a type of house, and we're currently in there at the moment, Andrew and myself in Birmingham, and this is our office. It's called Joseph Mews. And the reason that we're called Joseph Mews is based around Andy again. So he's been very successful in the property industry, as we've said, but his biggest success that he'll tell you is based on the brain tumor charity that you'll see there. In the brain tumor charity is the largest brain tumor charity in the world. So it's an incredible achievement that Andy's managed to start this, and obviously what he's achieved there has been remarkable to sort of get the accolades it has. So we've named our business after Joseph, who is Andy's son, who sadly passed away from brain tumor, and obviously the charity was made in his name. So it gives legacy to Andy, to his son, and everybody involved. So we obviously want to support the charity as much as we can. So we obviously, if you want to hear more information about it, then do let us know. Coming on to the next slide, please. So in terms of our track record property-wise, this is the amount of properties we've delivered: 3,480 units that have been sold and delivered, 34 developments, and just under £600 million worth of property. So it's an extensive track record, and obviously, depending wherever you are in the world, it's important to know who you're dealing with and what the track record is. So this has come from obviously experience, Andy's experience, and also all of our staff knowing which locations we want to deliver, being able to be partner with some of the best developers in the country to achieve this. Let's go to the next slide, please. So as I mentioned, we partner exclusively typically with some of these developers that we know have great track records, that we know we can rely on. And, a lot of these names you may not recognize on your screen, but they're big developers that have great track records. But a name that you might remember or know is Knight Frank. And obviously being the most respected consultancy in the world, really, it's been a massive privilege of ours to be able to partner with Knight Frank's land team. And what I mean by the partnership is that we partnered with their land team in the Midlands, which means that anytime they sell a plot of land to a developer in the Midlands area, so your Birminghams, your Derbys, we have Joseph Mews are exclusive distributors for that developer. So it's a massive positive for us as a business to be able to offer our clients and investors properties that have obviously had huge amounts of due diligence done on them. Knight Frank don't affiliate themselves with anybody, and obviously it's important to remember that when we're looking at the developers we deal with, huge track records, huge portfolios that are already existing, and the Knight Frank name behind it. So it should give you comfort, especially when buying off plan, that you're dealing with the right people. So we've got a couple of developments with them at the moment, but as I said, all of those developers you see on your screen have great track records and a vast history. Next slide, please. So again, look, this is sort of coming on to where we are today. We want to help our clients with every side of the investment, whether you are in the UK or whether you're 9,000 miles away. It's the same process. You know, exchanging contracts, you need a solicitor, a lawyer. Mortgages, obviously, where we are today. Agents on the ground, who's going to rent the property. All of these things you've got to consider. And it's not an easy process. It's extensive. It takes a long time. But this is what we help our clients with. And so today, obviously, we're focusing on mortgages, and that's a really important part. Over 90% of our clients take mortgages wherever they are in the world. And so being able to understand what your options are there, it can be quite daunting and frightening. Where do I start? And so having those relationships with both Visionary Finance and the Maidwell Group is imperative to us, because it obviously alleviates some of that stress and time for our investors knowing where to go. So every single side of it, Joseph Mews will hold your hand through that process. And as I say, it's one of our biggest strengths. Next slide, please. So yeah, as I say, there's a Q&A at the bottom of your screen. So if you do have any questions, then please just type in a question in there. We will answer them at the end. We're doing a dedicated Q&A session. So if anything crops up that you want answered while we're going through the webinar, then just give it a type and we'll answer it at the end. Next question, please. So to look at a case study of what we've done before, I think it's really important, particularly when buying off plan. So I'm going to use the most recent example. This is a development that we handed over in the beginning of this year, in January, last month. It's called Lockside Wharf, and it's in the center of Birmingham. So if we go to the next slide, please. You'll see this is a CGI of the development. We sold this property off plan. We sold it 18 months before it was being delivered. So we were selling based on CGIs, based on renders of what the property was going to look like, how much they were going to rent for, and the quality. One thing we knew is that we could trust the developer that we were working with, and we managed to sell it out in 8 months, which was 12 months ahead of completion. So as an investor, when you're buying, as I say, off the plan, literally, it can be quite daunting. And so it was a huge success, and it was amazing for us to bring our clients over and look at what was actually delivered in January this year. And if we go to the next slide, based on the back of the quality, which you'll see shortly, they won awards. They won the best architecture multiple residence in the UK. It was actually shortlisted for the best architecture in the whole of Europe. And this is testament to the type of properties that we want to offer our investors. It's not just your carbon copy new build developments. We want to add something special that stands the test of time and is going to give you the best chance of a profitable exit strategy in the future, as well as obviously a consistent rental. So this is a great example. And if we go to the next slide, you'll see these are real photos, and look, the quality speaks for itself. The finishing is really remarkable. They've been incredibly successful renting, both from a long-term let as well as a short-term let angle, right in the heart of the city. And again, just the finish and the quality is really fantastic. So if we go to the next slide, based on that, 5-star reviews from everybody that bought in there, and it's been a great string to our bow as a business to sort of put into real life what it is we talk about and our commitment to the quality and only dealing with the best developers that are going to be the best investments for you. Next slide, please. So we've got a poll question now. We'll hope that it works. That technology, as we know, can fail us sometimes, but it should come up on your screen. And the question is, are you looking to invest in UK property from within the UK or from overseas? 50% of our clients typically, as I said, are from the UK, and 50% of our clients are based overseas. As I say, we've got an office in Dubai, Johannesburg, Hong Kong. So it'll be great to understand where our audience is today on this webinar. So if you just click that, it should give us the results soon. There we go. Okay, quite a split here. So we got 75% from overseas and 25% from the UK. It was similar to our earlier one. Typically, it's closer to 50 and 50, but yeah, it's great to know who our audience is. And as I say, for the 25% of you and the 75% of you, you're going to have important and relevant information coming from both Hitton and Sophia. So without further ado, I'm going to hand you over to Andrew Siegel, who's going to give you a slight introduction to the UK property market before we go on to mortgages and a bit of an update as to what we're looking at for the rest of the year. Thank you very much.
Thanks, thanks, Johnny. Yeah, we've done, as Johnny said, we've done previous webinars, and in fact, you can go to our YouTube channel because I just want to touch on the property market briefly. But there's plenty of content and videos when we look at sort of top 10 places to invest in the UK and more of a general view of the market. If I can have the next slide, please. Thanks. Obviously, we talk to thousands of investors and potential investors I've done over the years, and we look at where the market's going. And as you know, with recessions, Trump, war, Brexit, it's doom and gloom, property prices are going to crash. You never have, and I don't think they ever will, because it's all about the supply and demand dynamics. For decades in the UK, we should have been building 320,000 homes. Best we've ever done in decades is 200,000. If we built the number of homes we should be building today, it's going to take 50 years to make up that shortfall. So that supply and demand balance is really important, particularly as an investor. That has a massive impact and a knock-on impact to the rental market. We're seeing, particularly in Birmingham, one of our strongholds, 50% less property than there was on the market for rent 2 years ago. Rents went up 14% last year. So it really is the perfect storm. And then you look at certain cities, and obviously we do a lot of research. We've got a lot of regeneration, new train links, new companies relocating further north to save costs. So perfect time to be a buy-to-let investor. And also, obviously, we've got things like stamp duties and taxes and fees and charges. So back in the day, you could buy a property, as I did, and flip it. You could buy it off plan and sell it again off plan before it was built and make good money. That market isn't there these days. So it's about holding the asset for a period of time, ideally a minimum of 5 years. And even if we look at, which I did, was buying property at the height of the market in 2007 before the recession. Yes, we had a dip in prices, nothing crazy. But guess what? Those property prices have more than doubled since then. So if you're in it for the long haul, houses is a safe bet. When we look at sort of forecasts and pricing, property prices probably stayed pretty flat depending on what area you were looking at last year. And this year, I looked at January nationwide, there's property prices are at 0.7%. It's just in 1 month this year, 24. Rightmove have reported for February so far, and we're not quite at the end of the month, 0.9% rise. And again, Knight Frank and a lot of the PLCs are forecasting a minimum of 4 to 6% growth this year. We're seeing that already, and we can see that. So perfect time to invest in property. Always has been, always will be. Look at the next slide, please. So again, we've got stability, or certainly nice gentle rise in house prices. Predictions have been revised from a sort of slower growth to a bigger growth, and I think we can all understand why that is. The guys, when we talk mortgages for UK and offshore clients, will talk about rate forecasting as best they can and look at what impact that has had and potentially will have mortgage rates. They'll look at 2024 expectations as well from a mortgage point of view. And again, looking at history will give us hopefully a good indication of what the future is going to bring. Next slide, please. Thank you. Okay, before I hand over, I've got a quick poll question for you. How do you currently perceive the future of the UK market? So are you looking to finance your UK property from within the UK or from overseas? Is that a different question? Yeah, we'll get the right poll question. I'm sorry about that. This is only water, not vodka. It's not me operating the controls, so you're fine. Let's see. If we don't get that one up, we'll go on. Don't worry. If we don't get that, we can go on to the next slide, if that's not going to come up. Okay. So let me introduce you, first of all, to Hitton from Visionary Finance. And he's going to look at financing your UK property as a UK-based client. Thank you.
Thanks for the introduction, Andrew. Good evening, good afternoon, wherever you are located in the world. It's lovely to be on this webinar with you all. As Andrew mentioned, my name is Hiten Ganatra, MD for Visionary Finance, and today I'm going to be talking about more from a UK mortgage market perspective and to give you context around where the market is currently, where the market was, and what we expect to see in the future. So if we could go on to the next slide, please. So Visionary Finance, we were founded in 2008, so an established firm, and have grown quickly to become one of the UK's leading mortgage brokers committed to providing impartial and transparent mortgage advice. We have access to over 80 different lenders. Now that equates to over 5,000 different mortgage products, from high street banks to specialist lenders. So all the mainstream banks that you see on the high street as a UK sort of resident, as well as specialist lenders who specialise in supporting landlords growing their portfolios. So essentially, we have access to, as I said, the full suite of lenders that can help you achieve your investment objective. We've facilitated over £500 million worth of lending since 2020, helping over 3,000 clients with their mortgage requirements. We're an expert professional, and we provide expert, professional and impartial advice, and pride ourselves on delivering excellent customer service, which can be backed up by over 200 5-star Google reviews. So that's a little bit about ourselves. Can you please move on to the next slide? So this is another poll question. Hopefully it works. And the question that we're asking here is, how we go. What factors are most important to you when considering financing options for investing in UK property with a mortgage? So if you just make your choice there. Is it interest rates, lender product fees, loan to value, or maximising cash flow? Hopefully, will it work? There we go, and here's the outcome. So 44% of you said that interest rates are a pivotal factor in influencing your investment decision. 8% said lender product fees, interesting. Loan to value, 16%, and maximising cash flow, 32%. So I guess it's interest rates and maximising cash flow almost probably go hand in hand, because with lower interest rates you get a greater cash flow. So that's really interesting, and that probably says that about 70+% of you want that cash flow objective, which is great. Thank you for completing that. Can I have the next slide? There we go. So UK mortgage market update for 2024. So what's happening in today's mortgage market? So we're seeing an increase in affordability. Lower rates are improving affordability, potentially stimulating demand. People are at the position where they've sort of sat on their hands for the last sort of 12 months because we've seen a lot of volatility with rates, etc. And so with the markets forecasting rate reductions, swap rates improving, we're seeing rates becoming more competitive, and people are saying, well, actually enough's enough, let's just get moving on and let's do what we need to do with our investment objectives. So and the affordability is certainly helping that cash flow model that landlords are focusing on. We're seeing a rising in approvals. So mortgage approvals have reached a 6-month high, with over 50,000 applicants given the green light for house purchases in December 2023. So again, people are saying, enough's enough, let's just get on with doing what we need to do and growing our portfolio. Buyer sentiment is improving as well. There's early signs of pent-up demand and returning confidence. And again, that's just lack of supply out there, increased rental demands, and effectively landlords are saying, let's continue to invest. Let's take advantage of the market and the way it is at the moment. So we're seeing the sentiment improve, which is great. We've seen rates drop from 6.2% in July 2023, which is the period where we had a lot of sticky inflation in the UK economy, for it to reduce to around 4.7% in January 2024, and they are Bank of England figures, so these are averages of interest rates. So it just shows that we've seen a 1.5% reduction in the interest rates from within 6 months. So it's going in the right direction, and lenders are competing on policy to secure more opportunity. I mean, look, the pricing amongst lenders is pretty similar. The amount that the rate at which they need to charge their interest is there's not much variability in that. So what what are they doing? They're becoming a lot more expansive in terms of their policy. So, there isn't a set of circumstances that we can't assist a client obtain mortgage with, and the lenders are being more open-minded about client profile circumstances and accepting more a broader framework of clients. So again, that's a positive move in that lenders are now being a lot more sort of open-minded about lending to home buyers in the UK. Can I have the next slide, please? So what are the costs beyond the UK property purchase price? So in this slide, I'm just going to cover off the cost considerations that you need to have, or the funding considerations that you need to have in order to purchase a UK property. And the first thing, of course, is the deposit. Deposit's not a cost; it's the money that you need to put into the purchase in order to make to fund the purchase. So essentially, with a buy-to-let investment, you're looking at around 25% deposit. If it's a residential purchase that you're looking to move into, there are lenders out there currently offering mortgages of 95%, so you only need a 5% deposit. But that's the money that you're going to be injecting into the purchase. The second element of the cost is the stamp duty, land tax. Unfortunately, there's no getting away from this. When you acquire new property, you have to pay SDLT, and the rate that you'll be paying will be determined by the purchase price and the slab that it falls within, and whether it's a buy-to-let or whether it's a limited company purchase. So again, your solicitors will be able to guide you on that, but you'd need to have those funds available because you can't borrow against the stamp duty, land tax. You have to have those funds available, including your deposit. The next is the conveyancing fee. So they're your legal fees to carry out the purchase transaction. Essentially, whenever you purchase a property, you need a solicitor to represent you. Joseph Mews, Johnny, and Andrew have relationships with a number of solicitors, good solicitors that can act on your behalf at competitive fees to ensure your purchase is securely made. There are lender fees. So lender fees include things like the mortgage product fees. They include things like evaluation fee. They include product fees, interest rates, etc. So those are the sorts of fees that the lenders will charge. And ultimately, our objective is to find you the lender that offers you the best solution, the most cost-effective solution to meet your investment objective. There's the broker fee, which is the fee that you pay a mortgage advisor typically for arranging your mortgage for you. And our service to yourself is a 360 service. So we effectively qualify you as an individual, understand your circumstances, your profile, etc. Then we provide you with high-level options and our onboarding paperwork. Once you send that, we assess your circumstances in a greater level of detail. Once we've assessed those details, present those options to you, and we manage the application process from submission right through to mortgage offer. So, as I said, you get a 360 service, and it's really important whether you use our services or another advisor service that they effectively provide you with a whole of market service, so they're acting in your behalf and in your best interest. The next thing is the next set of fees. You're looking at letting agent fees. If you use a credible letting agent, obviously there will be fees that will be payable to them. And typically, it's not really a sort of a physical cost yourself. It's not an actual cost that you'll be making. But when you do get your rent coming through, they'll deduct their fees off the rent that they'll be paying you. So essentially, it's not something you have to put your hand in your pocket to pay. It'll come off the rent. You've got landlord's insurance, and it's typically advised to take some level of landlord protection insurance out just in case your tenant stops paying rent. They might fall on hard times, etc. So at least then you know that your rent is covered, so that your mortgage obligation can be met in the absence of you receiving the rent directly from the tenant, as the insurance will cover that for you. Property maintenance, very little needed or need to be set aside for this, because you're essentially going to be looking to acquire new build properties which come with warranties, etc. And that gives you that safety net that you're not having to set money aside to sort of cover damages or anything property related. So, the benefit of buying a new build is certainly the fact that it's a turnkey type investment. Gas safety checks, etc. Which again, due to the green initiative that the UK are implementing, many developments aren't necessarily installing gas within properties. Everything's electric, so you could possibly avoid this cost. And then there's obviously tax on rent received, and there's one thing we can't get away from is tax. Whether you buy it in your personal name or a limited company, tax will be payable on the net rent that you receive. So these are sort of the broad costs considerations that you need to have in mind for your UK property purchase. Can I have the next slide, please? So this slide helps to give a bit of some scenarios as to the types of clients that we can look to assist through our network of lenders that we have available. So the first scenario is that we do regularly help clients who are purchasing their first UK investment property, and they want to get on the property ladder to be able to build their portfolio. Now, they could be a first-time landlord, or they could be a first-time buyer where they have never owned a property. In both scenarios, we have access to lenders that can help these two situations, where if you're buying your first investment property, we have lenders that can lend you up to 75% to get your foot on the investment ladder. The second scenario is financing additional investment properties. So we've got clients that are sort of a small portfolio landlords that have 3, 4, 5 properties, and we've got those that have properties in the hundreds. And in any scenario, whether you're a small landlord or whether you're a large portfolio landlord, there are a number of different lenders that lend to your profile of circumstance. So, don't feel as though because I've got X amount of properties, or I've not got enough properties, that I'm not going to get lending options. There are sufficient lending options out there to support your profile, no matter how many properties you have. The third scenario is financing UK property from overseas, and that's something that my colleague Sophie is going to touch on shortly, who will speak specifically about funding for UK property purchase from abroad. There's financing off-plan properties as well. So typically on off-plan properties, they are up for build completion, 12, 24, 36 months in advance. And what we essentially do is help give you the qualification element of these properties and qualify your circumstances to make sure that when you do come to apply for the mortgage, that the mortgage will be available to you based on your profile. So again, would give you a good indication of your mortgage eligibility now, so that you're confident to put that deposit down to acquire the purchase. The last and final sort of circumstances that we work with is leveraging equity and other financing methods. If you're a seasoned portfolio landlord, you've probably built up a lot of equity over time in your portfolio. And what we can do there is review your portfolio to try and get you the equity release from your bricks and mortar, so that you can use that as deposit for further purchases. So again, we can help carry out a portfolio review to ensure how you can maximize the benefits of using that money saved up in the bricks and mortar as liquidity for you to acquire further purchases. So again, those are sorts of scenarios that we can help with. So can I have the next slide, please? So this is another poll that we've got here. What do you consider as the primary indicator of improvement in the mortgage market? So mortgage rates falling, rental demand increasing, lower inflation, Bank of England reducing their rates. What do you consider as the primary indicator of improvement in the mortgage market? Hopefully the results will come shortly. Here we go. So 25% of you said that mortgage rates falling is an indicator of improvement. Rental demand increasing, 29%. Lower inflation at just 8%, and Bank of England reducing their rates at 38%. So the winner is, of course, Bank of England reducing their rates at 38%. So thanks for taking part in this poll. If I can go on to the next slide. So this part of the presentation, I want to talk about financing just giving you some examples, case studies, and what makes you mortgage ready. So if I can have the next slide, please. So how do I invest in UK property with a mortgage? Okay, so the question that number one that we get asked quite regularly is, can I get a mortgage for my UK property purchase? Short answer is yes. No matter what your circumstances, whether you're a first-time buyer, first-time landlord, and the scenarios that I went through earlier on, evidence is the fact that in any circumstances we can help you get a mortgage. Now, if it's for something that you're looking to acquire to live in yourself, there are lenders out there that can lend up to 95% value of the property. If it's a buy-to-let, 75% is typically what you would go for, or what's available to you. There are certain lenders that could go up to 80% borrowing. So for any type of property purchase, any type of client circumstances, are there going to be options available to you? Yes, there will be. So the answer to that, of course, you can get mortgages, and certainly speak to an independent broker that allows you to the full bandwidth of lending options that are out there. Question number 2 that we get asked is, how do I become mortgage ready? Becoming mortgage ready is making sure that your paperwork is in order. So, for example, income evidence is what lenders will need to see. Now, what we do say to clients is, even though you've got no income or a small amount of income, when you're doing a buy-to-let investment, you can still get a buy-to-let mortgage with a small amount of income. Now, small amount of income, it could be under £5,000. As long as you've got taxable income, there are lenders out there that will consider you for a mortgage if you've got experience in the mortgage sector, if you've got experience in the buy-to-let sector, space, etc. And even if you've not got experience, as long as you've got some level of income, because they use the rental income as a yardstick to lend you and assess your circumstances. So paperwork is really important. Bank statements, pay slips. If you're a limited company incorporated, then essentially we need company accounts, etc. But it's making sure that your paperwork is in order so we can evidence your profile to the banks and the lender so that they can get comfortable around your overall eligibility. Number 3, what costs are involved with buying through a mortgage? So the lender cost, typically there are 3 main costs. You've got the lender product fee, which typically doesn't have to be paid up front, but it's a fee that can get added to the loan. And most of our buy-to-let investors do add the fee to the loan. There's the valuation fee that typically needs to be paid up front, and that's made at the time of application. And then there's the application fee that the lender typically charges as well. So those are the 3 main fees that the lender will charge when you're buying through a mortgage. And again, depending on the value, will determine what each of those fees are. The product fees are typically percentage fees these days. Valuation fees dependent on the purchase price. So again, we would communicate these to you, once you're ready to sort of proceed with a mortgage application. How many options do I have? Well, we've got access to over 80 lenders. Now that equates to over 5,000 mortgage products. So we always say to our clients is, look, there's never really a circumstance or a scenario that we can't help our clients with. It just depends on how complex your scenario is. How many parameters we need to satisfy with the lender to get you the right lender will determine how much risk the lender's taking on you. And that will then determine the rate and the product options that are available. If you're a vanilla client with, and what I define by that is someone who's got a couple of buy-to-lets in the background, is employed, got good salary, and has got the experience, you can get some really, really competitive rates out there. And so that'll open you to a broad range of options. But for example, if you've got any form of credit blemishes, county court judgments, maybe some defaults, again, don't be deterred by the fact that you can't get a mortgage. We can certainly help you obtain mortgages. It might be reflective on the rate that we end up, going down, because of course there is a slight risk associated with you as the applicant. But that's not to say that after that credit blemish does get removed in 2-3 years time that we can secure you onto a better rate. So don't feel that because you've got some quirky set of circumstances that you're not going to be eligible for a mortgage. Certainly speak to an independent broker that can give you that option and the options available to you. Question number 5, what are the factors affecting mortgage eligibility and interest rates? The main factors are, of course, sentiment, where the Bank of England is expected to be putting up base rates, or where the base rates are heading. And if we look at the market confidence and where markets are predicting, we're expecting at least 2 base rate reductions this year in 2024. And so that has an impact on the interest rates that the banks are charging. There's also the swap rates, which is the wholesale rates that the banks borrow at. So they go to the wholesalers in the wholesale financial markets, borrow a large tranche of money, and then piecemeal them up into small mortgages. And those wholesale rates of interest has actually fallen. So again, that has a real positive impact on the rates that are available. And in slides ahead, I'll be going through the case studies of where rates were at and where rates are sitting now to give you context about how that market is improving. Mortgage eligibility is down to sort of demand. Banks are becoming a lot more expansive in their policy because they're confident the fact that there's not a risk to the housing market, so they're being a lot more open-minded about the types of clients that they will accept. So again, it's that sense of confidence that is in the market that's allowing us as more of a less of a challenge in terms of securing good rates for our clients. Number 6, as I've mentioned a few times, speaking with a mortgage broker to help you find the best deal is really important, because, as I said, you might speak to your bank who might say that you don't fit with their lending policy. That doesn't mean that you're not eligible for a mortgage. So speaking to an independent broker certainly is worth its weight in gold if you're looking to grow a serious and a sizable portfolio. Can I have the next slide, please? So key factors lenders consider when assessing mortgages eligibility. The first is the credit profile, and as I touched on this, no matter, if you've got a 999 credit score with the credit bureau agency, absolutely fantastic, and that broadly opens up you to a whole suite of lenders. But if you've got blemishes on your credit profile, for example, you may have a county court judgment, you may have a default, you may have a missed payment. Let's discuss that. Let's try and understand what that is, why that happened, and how long ago it happened, because there are going to be lenders out there that after a certain period of time just ignore those blemishes. As long as you've paid them off and you've paid your dues, etc., we can certainly find you a lender that's best suited to your circumstances. But having a good credit profile means that you can attract almost the sort of the tier one, the best lenders in the marketplace. The next element of his income profile, again, which I touched on, is the income profile is important. Is it critical for a buy-to-let mortgage? No, it's not. As I said, we've got lenders out there that don't say that as long as you've got a UK income, be it as small as a couple of grand, we can certainly get your mortgage. They'll look at your experience, but of course, the greater your income profile, the greater the confidence of securing a tier one lender who has the most competitive rates in the marketplace. Client experience, again, important but not critical. Lenders, if you're a first-time buyer, never really owned a property, but you've got adequate income, can we get you a buy-to-let mortgage? Absolutely, we can. Can we get you on the housing ladder with a 5% deposit? Absolutely, we can. If you've got a portfolio you own through a limited company, you're an experienced landlord, etc., does that open you up to a suite of buy-to-let lenders who will be, itching for your business, crying out for your business? Absolutely, we can. And of course, as I said, our objective is to try and get you the best deals that our clients by doing the market research. Payment structure, again, key. One of the elements of it is how your sort of payments are structured with the developer, etc. That is something that is not absolutely critical, but it's something that is considered. We just need to make sure that we work around that to say how much deposit you paid and how we structure your sort of mortgage. Property type, again, there isn't really a property type that we can't lend on, and the more vanilla the property type, so it's a house, a traditional flat, not an issue. But even if you've got, say, quirky property types that have unique aspects to them, there are many lenders that, subject to valuation, they'll be open-minded about lending on them. And let's not forget, you'll be investing in new build properties, so they generally tend to form with building regs, framework, and have the necessary warranty providers in place. So this is less of a concern. And the rental income's the last thing that is considered when you're doing a buy-to-let mortgage. The rental serviceability is pivotal in terms of ensuring that the mortgage that you're going to be paying is covered by the rental income that you're receiving. So, and that is stressed at a certain level. And of course, when we do sort of look to help you, we'll understand what the rental income is that you're expected to achieve versus the interest rate that you're going for, and that will help us determine how much you can borrow. And typically, we're able to get 75% because the deals that Joseph Mews are essentially putting to their investor clients it does have the yields for us to be able to achieve you that full 75% loan to value on a buy-to-let basis. Brilliant. Can I have the next slide, please? So, case studies, just going to run through some case studies, how it started sort of middle of last year with inflation being sticky and rising, etc., and how it's going now. So if I could have the next slide, please. So this is an example, a real life example of a client who was purchasing a property for £300,000. The rental income was £18,000 per annum, and the mortgage the client secured was £225,000, which is 75% loan to value. So this client actually was supported in 2023, Q2 of 2023, when it was a little bit sticky in the market with inflation being where it was. The rate we secured for the client was 6.39%, best available in the market at that time. That's what we managed to, that was out there, and that's what we secured for the client. Monthly payment was 1198 per month. So the net monthly cash flow after mortgage costs for the client was £301.87. Now, roll on 6 months, 7 months, February 2024, if we would have been applying for that client today, the rate that we could have secured for we can secure for the client at the moment is 5.09%. Monthly payment on an interest-only basis today is £954, giving a cash flow to the client of £545.62. So you could see there's over £200 uplift on their cash flow just from 7 months. And of course, that just shows you the trajectory of where the rates are going. The rates are down by 1.3%, have come down. So that's a significant chunk off of the interest rate that the client unfortunately had to pay because of the timing of the completion, etc., to where it is today. So you could see that the sort of the direction of where this is going is certainly the positive way. If we could have the next case study, please. So this case study gives you an example of a personal name mortgage. So this was a client purchasing a property of £193,050. Rental income on this property was 15 grand per annum. The mortgage the client secured was 144,787 spot 50. Okay, again, an example based in Q2 2023. The rate secured was 5.24%. The monthly payment on the debt amount of £144,000 was £632.32. So the net monthly cash flow this client was getting was £617.76 per month. 7 months on, today the client, if he were to apply for that same purchase, it would be 4.44%. So again, a 0.8% reduction in the rate. A monthly mortgage payment today would be 535.71 pence, giving them a cash flow, a positive cash flow of £714.28. So, you know, it gives a real good sense of, you know, where the market was and where it's going. And we would expect that, you know, the forecast for the next sort of this year certainly is the fact that we will see a further softening of rates in some way, shape or form. I think we've got an election year coming up, so there's a little bit of tentativeness with banks, but definitely from what we were sort of 7-8 months ago to where we are now, it's definitely, you know, something that is for sure going in the right direction. Next slide, please. So what is bringing about this change in rates? So firstly, lender sentiment about UK housing market is strong. We had the nationwide house price index, I think, come out a couple of weeks ago that said that house prices have remained stable. In fact, have grown slightly, which again is a strong indication. Nationwide, being one of the country's biggest lenders, is coming out with some positive mood music around that, and the rest, of course, follow. Competition for business is hotting up. Lenders are squeezing their margins, being more expansive around policy. So essentially, what, you know, it's driving down price. Of course, as competition goes up, prices will be, you know, affected in a positive way for mortgage clients. Swap rates are stabilizing as well. So I touched on this earlier on, in that the wholesale swap rates that banks are borrowing at are falling. You know, we had swap rates back in sort of the middle of last year, 5-year swap rates at around sort of 5.7, 5.8, touching 6%. Those swap rates sort of middle of January were down as low as 3.2% on a 5-year deal. So essentially, the lenders are able to borrow money from the wholesale markets at a lot cheaper rate, and so they're reflecting that pricing in the mortgages that they're charging to their clients. So again, that's having a positive effect. And markets are expecting at least 2 base rate reductions this year. I mean, you know, all the sort of investment banks that you're speaking, the economists within these investment banks are saying that we're going to see at least 2 base rate reductions. Inflation's going in the right direction. You know, it was forecasted to go up slightly, but it actually remains stable. So there is this sentiment that, look, that it won't be long before they do at least make 2 base rate reductions. Some are being more sort of bullish and saying there could be a 3 base rate reduction. So if they do go down by 0.25%, we are looking at base rates sort of hovering at around sort of 4.5 to 4.75 by the end of this year. So again, it's things going in the right direction. So that kind of gives a sentiment of where things are sitting about rates now. I think that might be my last slide. There's one more poll here. So if you were to invest in the UK property this year, what would be your preferred approach, through a limited company or as an individual? So the options are: a limited company, I want to build a large portfolio and leverage financing opportunities. The second one is limited company, I want to be more tax efficient and protect assets. Personal name, I'm just starting out. Personal name, I find it easier to manage. So if you could just pop your option in there, please. And the results are, oh wow, so pretty much a 60-40 split between limited company and personal name mortgages. So that's very good. Thank you for taking part in this poll. And I think that's probably my last finance. So I'm going to hand it over to Sophia now, who will take you forward with the UK property investment from an overseas perspective. Sophia, over to you.
Thank you very much, Hiten. And good evening, good afternoon, everyone, and thank you for joining today. So I'm going to touch on how to invest into the UK property market as an overseas investor. We're going to look at the different types of mortgage options available, the different structures available, and the mortgage process for yourself as an overseas investor and what is required. So if we can just jump to the next slide. Thank you. So just a little brief introduction into ourselves. So Maidwell Group are an international mortgage brokerage headquartered in Dubai, and we specialize in clients based globally, but looking at investing in the UK predominantly. Now that can be whether you are a first-time buyer who's perhaps never even stepped foot in the UK, looking at investing for the first time in the UK, or perhaps you have a few properties and looking at growing that property portfolio. And finally, we can also assist with clients who have properties in the UK and perhaps you've held onto those for quite some time and they have gone up in value and you're now looking at accessing some of that equity that's built up in that property, in which case we can look at doing a capital raise against that property in order to help you reinvest that into another property. We work with over 700 lenders globally. So not just the likes of Halifax, Nationwide, or NatWest, that I'm sure many of you have heard of, but we also work with a range of private banks, private equity firms, funds across the UK, Europe, and the Middle East. So regardless of your circumstances, whether you are recently employed, whether you've recently retired and don't yet have a fixed income structure or a very straightforward income structure, there are lenders that we work with that we're able to place with you and meet your requirements. Next slide, please. Thank you. So we're just going to firstly look at some of the more commonly asked questions that we see from overseas investors. One of the first questions is, are there special requirements for expats buying UK properties? And in short, yes, dependent on the lenders. Like I said, there are building societies that we can approach for British expats. Firstly, most of them will require you to have a UK address, historical address even, in order for them to carry out a credit search in the UK. However, in saying that, even if you are a British passport holder, which sometimes is the case, and you don't have a UK address history, then there are lenders still who have an appetite and can certainly lend to you. Simultaneously to that, if you are a foreign national and perhaps haven't ever resided in the UK and don't have a credit footprint in the UK, then that's not a problem. We work with lenders who specialise in international clients who are first-time buyers. There isn't a requirement as well. I think it's important to note for you to even be in the UK throughout the whole process. We can do that all electronically as well, from overseas and over Zoom like today. So there are certainly lenders that have an appetite, and dependent on your experience as a landlord, I suppose, which we'll go into a bit more detail, there are lenders that can certainly accommodate you. How do property taxes work for non-residents in the UK? So the main taxes to consider are income tax and stamp duty land tax when you purchase a property in the UK. It's important to speak to a specialist tax advisor, but in short, dependent on your circumstances, stamp duty is one that you would need to consider, which is when you purchase the property that's due on completion. And income tax, dependent on what income you earn in the UK and how the purchase is structured, so whether it's in your personal name or whether it's in a company, which is known as a UK SPV, if you decide to purchase it in a structure, ultimately that will then determine what level of income tax you will pay. What we do is when we go through our initial conversations with you, we carry out a fact find, which is when we go through details on your income and ascertain what is the best approach for you. At that point, we can then decipher what the best structure might be as well, and then you will have a clear indication as to what tax implications there may be, if any. What's the process for overseas investors to sell UK properties? So I'm going to touch on this very briefly because I think the team at Joseph Mews will be able to go into this in a bit more detail, and particularly dependent on where the property is that you are selling, they will be able to point you in the right direction for an agent in that area, and they have the relationships with the agents on the ground. But typically, if you have a property that you're looking at selling, the first thing would be to instruct or consult a solicitor to represent you throughout the whole legal process and manage the sale. Importantly as well, simultaneously, you need to instruct a local estate agent, get someone to carry out a valuation on the property to give it a realistic appraisal, so you know what you're marketing the property for. At that point, once you've finalised on who you're going to be marketing the property with, they'll put it on the market for you, and as and when those offers come through, they will present those to you, and it is up to you to accept or not an offer. Once you have accepted an offer from a potential buyer, at that point, the contracts will be signed. And then at that point, that's when the solicitors will step in and work on the conveyancing and work towards completion and drawing down on the funds. And finally, what happens at the end of a mortgage term? I'm going to go into this as well in a bit more detail, because this often is determined by what mortgage structure you go for. The types of mortgages available in the UK vary, so dependent on that will determine what happens at the end of the mortgage term. But in short, there are a number of ways or a number of things that can happen. At the end of the mortgage term, you can either repay the mortgage in full. That can either be through savings. You can sell the property and repay the lender back, or alternatively, if you have gone for a capital repayment mortgage where you are paying down the loan every month, then at the end of the mortgage term, that mortgage is going to be fully repaid, so you won't owe anything more to the bank. But I will touch on capital payment mortgages in a bit more detail later on. If we go to the next slide, please. So just going to go through the key factors UK lenders consider when assessing mortgages from overseas clients looking at investing in the UK. The first thing being income and employment. So as I said, when we have our initial consultations with you, we will go through your income, your expenditure, details on any other commitments you have in the background, and of course, what you're looking for from the mortgage and what your objectives are. When we do collect the details with regards to your income and employment, that then enables us to decipher which lender we are going to go to. And that's important to highlight, because some lenders, for example, require you to provide pay slips or be in full-time employment, whereas other lenders are a little bit more flexible and perhaps don't mind if you've recently retired or if you've recently started a new business. Some lenders also don't have any minimum income requirements because it is a buy-to-let property that you will be looking at. The affordability for the mortgage can be assessed purely on the rent that the property is going to achieve. So it's important to see what income we are demonstrating and what your employment or self-employment status is like, and then from there we can determine who we're going to approach. Your credit history is important, certainly. It doesn't necessarily have to be a UK credit history. Some lenders will require that you have a UK credit footprint, but this isn't necessarily all of them. Like I said, there are lenders who don't require you to have any credit history in the UK at all. Now, some lenders may ask that you have the equivalent of a UK Experian or an Equifax report in your home country. That is easily accessible online. It's the equivalent of about £20 usually, and you can download that and provide that to the bank if they request it. Landlord experience. So some lenders ask that you have landlord experience. Again, that doesn't necessarily have to be in the UK. Some just require that you have experience being a landlord wherever, even in your home country. That's not a problem. However, again, that isn't the requirement for every lender. Some lenders are happy to lend to first-time buyers and first-time landlords, and the majority of them for overseas buyers, in fact, don't have any requirements for landlord experience. Typically, banks, there's a term called portfolio landlords, which I'll touch on a little bit later, and how you can become a portfolio landlord. And typically banks will look at that, and if you own between 3 to 5 or more properties, at that point you may be considered a portfolio landlord with certain banks. So that's one thing we will look to find out at the early stages of our conversations. And deposit and down payment. Now, this is quite an important point to highlight, especially as an overseas buyer, because whether you're buying a property which is completing in 3 months' time, or perhaps it's due to complete in a year's time, it's always important to just make sure that when we do come to preparing the application for the bank, that we're able to demonstrate where your deposit has come from and how it's been accumulated. So whether it's come from savings or whether it's come from liquidating some investment policies that you have, or perhaps it's come from a gift from a parent or a close relative, we need to be able to demonstrate to the bank where that deposit has come from. So typically they will ask to see 3 months bank statements demonstrating that deposit build up from either your salary credit, for example, but we need to just be able to demonstrate that to the bank. And a UK bank account. Now, most banks, however not all, will require you to have a UK bank account with an account number and sort code in the UK. That is to repay the mortgage on a monthly basis, and that also can be the account that you would use to collect the rent from your tenants every month. Now, we can certainly assist and point you in the right direction to set that up if you don't yet have one. Alternatively, there are lenders who don't necessarily require you to have a UK bank account. So if you are struggling to open one, or you're finding it quite difficult, there are certain lenders we can approach who are happy to accept the repayments coming from your account in Zimbabwe, in the UAE, or wherever it might be. Currency exchange risks. Now, this is important again to highlight, because this often comes up at the beginning process of a mortgage application. Banks sometimes, in order to assess the affordability of a mortgage, they will look at the potential currency exchanges and look at worst case scenarios to see whether the mortgage is still affordable. So right at the early stages, when we assess the mortgage options for you, we will look at the exchange rates and see how those fluctuations could affect the serviceability of the mortgage, which brings me on to my next point, which is the repayment capacity. So it's just important to look at, like I mentioned, all of your other commitments in the background, all of your other expenditure and so on, and any debts that you have in the background, because although it is a buy-to-let property, banks take two approaches when it comes to buy-to-let mortgages. One is basing it purely on the rental income of the property, whereas other lenders might look at a combination of the rental income that the property is going to generate, plus look at your personal income. And that sometimes is used in order to obtain a higher loan to value or a higher loan amount. So banks can do what we call top slicing. So they'll look at your surplus income every month. And if you have sufficient surplus income, they'll be happy to increase the loan amount up to about 75% loan to value, even as an overseas buyer, in order for you to get to that maximum loan to value. So looking at the repayment capacity overall is really important. And finally, the maximum age. We get this quite a lot, so it's an interesting one, but it's important to highlight. There are lenders that don't have a maximum age requirement, again, because it is a buy-to-let property. It's purely dependent on the rent sometimes, so there are lenders that don't have a cap. Others will require that the mortgage ends by the age of 80. Some will require that if it's going beyond state retirement age, they just want to see what income you will have following retirement. So again, dependent on, I suppose, what your goals are, how long you want to extend the mortgage term for, we can then decide which lender we're going to approach. Next slide, please. And I'm just going to touch on now the difference between purchasing in cash versus with a mortgage. And to do so, we're going to go through a little scenario to run through the figures. So the first line is based on an example on a purchase price of a property at £200,000. Now, assuming you buy a property at that value purely in cash and you hold on to it for 10 years, in 10 years, you then sold that property for £300,000. Now, your investment 10 years prior was £200,000. That was the cash that you put in. Your profit is £100,000, which equates to a 50% profit. Now, using that same example for that one property, you could alternatively look at purchasing that property with a mortgage and putting down just a £50,000 deposit. Now, again, you will hold on to that property and sell it in 10 years' time, and you will then sell it for £300,000. Your investment 10 years prior was £50,000 in this case, and your profit is still £100,000. However, as a percentage, that's now a 200% profit comparative to the deposit that you put down. And where you see the benefits of mortgaging and particularly leveraging is when you then look to, as I mentioned, grow a portfolio and become a portfolio landlord. So if we look at the next slide, you can see that as opposed to comparing it to the first example, putting the £200,000 in one asset, you can look at spreading that over multiple properties and buy 4 investment properties, thus equating a total asset value of £800,000. Now, in 10 years' time, you sold each of those properties again for £300,000. Your investment was £200,000 in total. As a profit, you've made £400,000, which as a percentage equates to a 200% profit. And that's where you see, as I mentioned, the benefits of leveraging. That's what most landlords will do. They look at leveraging, they reduce the amount of equity they put into one asset and diversify. And then in order to do that as well, another benefit is then looking at an interest-only mortgage, which leads on to my next slide, which is in the UK, you have 2 different types of mortgage strategies or mortgage structures, that we say. So firstly, you have what's known as a capital repayment mortgage, which is your conventional mortgage, what I'd imagine the majority of you this afternoon are quite familiar with. It's like a car loan, I suppose, or every month you're paying back part of the loan and the interest. So at the end of the mortgage term, that mortgage is fully repaid and you don't owe anything more to the lender. However, in the UK, you have what's known as an interest-only mortgage, and that's a mortgage where essentially you're paying purely the interest on the loan amount every month. So as a result, your monthly repayments are far lower than they would be on a capital repayment basis, which enables you to significantly increase your cash flow, enabling you, looking back at the previous example, enabling you to grow your property portfolio and diversify. So as opposed to spreading, putting your assets into just all your cash into one asset, it enables you to diversify. And then at the end of the mortgage term, going back to the point we made at the beginning, you will of course need to repay the lender back. And that can be from one of 3 main ways, really. That can be from remortgaging. So typically every 5 or every 2 years, you will look to remortgage. And that is when you move the mortgage from, let's say, Barclays, you move it to HSBC, because HSBC 5 years later, let's say, are offering you a more competitive rate. Alternatively, you can look at paying it off through savings or any other investments that you've had running in the background. And finally, you can look at selling the property and repaying the lender back. So let's assume you hold on to the property for 10 years. In 10 years' time, that property has doubled, let's assume. You can repay the lender back, take your profit, and move it on to the next investment. So those are the 3 main ways in which you can repay an interest-only mortgage. And it is one of the most common mortgage structures, particularly for buy-to-let investors. They don't want to put all their assets into one property. Ultimately, the aim is to grow your portfolio, increase your cash flow, which is why it remains so popular. We'll just go on to the next slide, please. Okay, so now that I've run through the interest only and capital payment, we're just going to run through a poll. It should have popped up on your screen. If you were to invest in the UK property market this year, what would be your preferred approach? Would it be a capital repayment mortgage or an interest only mortgage? Okay, so almost a almost even split. Interesting. Okay. I mean, what we normally do is when we have our initial consultations with you individually, we'll go through the mortgage recommendation. At that point, we can detail for you interest only and capital repayment and look at the monthly mortgage repayments on both. And then, of course, you can put those into the cash flows that the Joseph Mews team provide you specific to that unit. And you can see how the investment works for you and how the mortgage looks as well. If we just jump onto the next one, please. And finally, what factors influence your decision between an interest-only and a capital payment mortgage for your UK investment? So is it potential monthly cash flows, better risk management, investment strategy, tax implications, or lender requirements? Okay. Okay, so we're looking at about potential monthly cash flow, risk management, and investment strategy seem to be the most popular answers. And yes, certainly, as I said, we'll look at how those work for you on it for a cash flow perspective, and how overall that investment works for you. And then, of course, you can make a decision as to what's the best approach, really. Just jump onto the next slide. Perfect. So I'm just going to pass you back over to the team at Joseph Mews, who, apologies, before we do so, we're going to go through some case studies, some examples of where the mortgage market was 12 months ago versus where it is as of today, just to show you where interest rates have moved over the last 12 months. So the first example is based on a purchase through a UK limited company known as an SPV. So this is for, of course, an overseas investor who was looking at purchasing a property of just under £305,000. Now, the rental yield was 6% per annum, so that's of the purchase price. So that equated to £18,297 per annum. They were looking to achieve 75% loan to value, which was £228,712. So this time last year, the rate that we secured them was 6.54%. On a monthly repayment basis, and bear in mind this is on an interest-only mortgage, that equated to £1,246.48. Now, after their mortgage repayments were made, they were making a profit of £278.27. Now, if we were to fast forward those clients and their circumstances today, we would be looking at a rate of 5.89%, again on an interest-only basis. That would make the monthly repayments £1,122.59. So again, after the mortgage repayments are made, the profit would be £402.27. So you can see that's over a £100 increase in their cash flow on an interest-only basis in the space of 12 months. And if we just go to the next slide, please. And this example is based, again, as an overseas investor looking at purchasing, but this time in your personal name. So this is again a purchase price of just under £375,000 this time. This property was yielding for 5.5% per annum, so at £20,622 per annum. The loan amount, again, we were able to achieve 75% loan to value, which is £281,212. The interest rate was 6.55% fixed. Now, these clients wanted the certainty that the rate wasn't going to change, so we put them on a fixed rate, which gave them the security as an overseas buyer that regardless of where rates went, their mortgage repayments remained the same. On a monthly basis, again on an interest-only mortgage, that made the monthly payments £1,534.95. So after paying the mortgage back, they were left with £183.55. Now again, those same clients, as of today, that rate has now gone down to 5.59%, again fixed. The monthly repayments have gone down to £1,309.98, and the surplus has increased drastically to £408.52. So you can see just in the space of 12 months where rates have gone. And this is the general trajectory of where rates are predicted to go over the next 12 to 24 months with a couple of base rate reductions and interest rates continuing to come down. Lenders remaining competitive within the market. So when one lender reduces rates, their competitors tend to follow suit just to remain competitive in the international mortgage market industry. Just jump to the next slide, please. Super. And I'm going to pass you over to the team at Joseph Mews, who are just going to go over some investment opportunities and some of their key properties at the moment. Thank you very much for listening.
Thanks, Sophia. Thanks, hitting some really good information there on the mortgage market. Good to see where we're all heading. I've got just a couple of slides, and then we'll look at how you can contact us and information that we can supply to you, and how you can have sort of consultations, whether it's mortgages or anything to do with property. If I could have the next slide, please. So you've sorted out your mortgage, your tax, you're buying with a limited company, all the things that you might want to pre-check out before committing. as Johnny mentioned earlier, we work with some fantastic developers in prime locations. Some of the previous webinars we've done have talked about where to invest for 2024. So we've got Settle, which is in Birmingham city centre, prime location. It allows the short-term let, so potentially for higher rental yields, roof gardens, co-working space, little gym area as well. Prices started for 245. We've only just released that one just before Christmas, so limited number left, and we're completing Q3 2024. So in fact, ahead of construction or ahead of build timing. Manhattan Loss in Bracknell, so that's something London commuter belt. That one's completed, ready, furnished and tenanted. So for those that want something now, that's a ready-made solution. We looked at Bradford. We're just seeing, again, good capital appreciation, good rental yield, and a nice low price point, starting from £120,000, deposits from 20%. So a nice product with a lot of facilities in a leafy area of Bradford, good communication links to get people onto the property ladder. We've got the favourites, we've got a couple of developments in Manchester. Again, with Manchester, Derby, and Birmingham in particular, massive regeneration. Again, we talk about what to look for when looking at a particular area. I mentioned earlier about property prices doubled on average over 13 years. So whatever you buy is kind of going to work, but we can do better than that when we look at a bit more detail in terms of who's moving into the area. With Birmingham, £16 billion of investment. We've got a high-speed train, which will be the icing on the cake. So again, we do a lot of research, and we've got a lot of that research, guides, webinars, everything's available on the website. And again, you'll see after how you can have a sort of one-to-one consultation with us and the team if you want to drill down into particular topics. I've got one more slide. Thank you. So this is a development actually Johnny and myself have just been to see this afternoon, just going through all the due diligence at the moment. I think it will pass the due diligence simply because it's a St Modwen development. They're a FTSE 250 company. They turn over billions every year. They have government contracts. Fantastic organisation. Very proud to be working with them. We've got a couple of blocks coming. We've got 24 units in the first block. It's Birmingham commuter belt. We actually drove out, about a 15-20 minute drive, but it's right on the train line. And on the train line on the way in, you pass, there's 4 stops. It's 20-minute train journey. Trains are every 12 minutes. You pass, and there's a stop at Bourneville, which is the Cadbury manufacturing plant, a big plant in the UK. You pass the QE Hospital. It's one of the biggest military hospitals in Europe, and it's one of the biggest hospitals in the UK. So you've got that sort of Birmingham commuter belt market, which is great because, of course, prices are less because we're further out of the city centre. And you've also got that local demand as well. There's big shops, there's a massive Marks and Spencer. So all the facilities that you'd want if you're local. And again, you've got that commuter belt market. Prices should be seeing starting from around £190,000. And uniquely, only a 15% deposit required. So 15% down now, the balance on completion, which can be cash or, as we've seen, ideally mortgages. So again, we'll let you know how to contact us if you want to talk particular developments or anything to do with property. I'm going to hand you over now to Johnny, who's going to talk about next steps and how to book a free consultation with us. Thank you.
Thanks a lot, Andrew, and thanks obviously to Hitton and Sophia. Hopefully you guys have found this useful wherever you are in the world. As we mentioned, we asked you to put in any questions. We're going to come on to them, but if we can go on to the next slide, please. Firstly, just to mention that we do have a referral scheme. So any of you that are watching today that you know somebody that might be interested or worth having a chat with, then we are running this scheme at the moment. So yeah, do pass over the details. We'll obviously send you an email after this, so you'll have an opportunity to do so pretty straightforwardly. We go to the next slide. Right, now, as mentioned, the Q&A session, we've had a lot of questions during this. And so I'm going to bring on Sophia and Hitton because they are predominantly to do with mortgages, as expected. So, right, so first to start with, and I think one for, well, for either of you actually. Does financing your UK property investments in 2024 include commercial properties? Obviously, it's not something that we do at Joseph Mews, but I guess just to understand if you know, from your side, if you guys do that.
Yes.
You go ahead.
Yeah, no, we do. I think commercial property is an inquiry. We do get regular inquiries around it. There are not as many lenders, but there are lenders out there that are still sort of keen to lend on commercial. It just depends on the type of tenant. There's a lot more due diligence that the lenders need around the commercial entity, the use class, etc. But we can certainly assist with that if that's your specific requirement. Yes.
Perfect. And then we've had, I guess, more specific for Sophia on that. How does the credit profile work for an overseas investor?
Sorry, there seems to be a background.
That I would be starting to school in a week. I never looked forward more to.
Can you hear that, or is that a?
Yeah, there is. Yeah, just keep going.
Yeah, go on, carry on, Sophia.
Well, right, Hitton, we'll go to you in the meantime.
Yeah.
Is it possible to have a pre-qualification and pre-approval of a mortgage facility before identifying the property as a non-resident?
Yeah, I can answer that on behalf of Sophia. Yes, that is possible. And I think we'd probably surely recommend that, because what you don't want to be doing is committing to buying a property if your circumstances aren't conducive to the lending profile and the clients of the lenders. So definitely, I know, we do provide a free consultation, as I'm sure Sophia will do as well, having the discussion with their clients and assessing their mortgage eligibility. So absolutely would strongly recommend that. So at least you know where you stand and what you need to do to make sure that you get to that position before you do agree to buy the property. So definitely something worth doing, and it's something that we can offer free of charge. Sorry, Sophia, I've spoken on your behalf, but I assume that is the case.
I think Siri was just going a bit crazy, but that is sorted now.
Perfect. Yeah, look, it's something that we obviously get asked a lot, both for clients in the UK and overseas, that particularly buying off plan, you can't get a definitive mortgage offer because they last 6 months. So 6 months and onwards before the property completes is when you can really kind of drill down into the specifics of what your offer is. But inevitably, as the same as me, when I first bought a property 2 years off plan, I had a chat with a mortgage broker to make my understanding that, right, based on my circumstances today, these are what my options are going to be. And so long as that doesn't change and I don't lose my job or change jobs or whatever, then I'm going to be okay. So yeah, as Sophia and Hitton both offer this as a free service, and it's definitely worth doing to give you some comfort. Let me work through this. You mentioned having presence in Hong Kong and South Africa. Will being based in these countries assist in making it easier for the application process for a mortgage? Wherever you are in the world, it's the same process, really. Whether you're, as I say, whether you're in the UK or anywhere, our offices in Dubai facilitate the whole of the GCC. Our office in Johannesburg facilitates the whole of Africa. Our office in Hong Kong, again, the same for the Far East and going into Asia. So it really doesn't matter where our office is. Everything is done remotely, regardless. And both with Hitton and Sophia, that's the way that we do things, and you don't need to be on the ground. So wherever you're based, it will be the same process. Next one. Are there any early redemption charges during the mortgage period for any advance payments or early payments?
I suppose, well, it depends on the mortgage that you're going to take out of. So in the UK, firstly, you have the option of going for a fixed rate mortgage or a tracker rate mortgage. Now, sometimes with fixed rate mortgages, there might be slightly higher early redemption penalties if you pay it off in full compared to a variable rate mortgage, which, let's say, tracks the Bank of England base rate or some trackers. However, in saying that, often lenders do allow you to make some overpayments every year at no penalty, typically between 10 to 20% of the loan amount, and that will chunk away at the outstanding balance. So you are still able to make overpayments at no penalty, just to reduce that loan amount if you want to.
Perfect. Thank you, Sophia. Another one for an overseas buyer. I have a UK limited company with a UK bank account. My wife and I are directors and 50-50 shareholders. She's a Spanish passport holder. I'm South African. We live in South Africa. Bought and renovated and sold a property. They want to know whether they'll be able to get a 75% LTV on the first mortgage in the UK with a competitive rate the initial investigations have found that the rate would be pretty high.
Yeah, I mean, so what we would do is, in short, we would have a consultation. We'll look at your income. We'll look at the property, look at the rent, and then we can go away and see what options would be available for you. In short, but there are 30 lenders that will go up to 75% loan to value. In short, even with an SPV purchase, with you being based overseas and international clients.
Yeah, what we'd always suggest is, and we're going to obviously send around the option after this, is for you to book in. Every situation is specific, obviously, to your own circumstances, but typically, we do a lot of business in South Africa as an example. The typical, you will get options up to 75%, but again, it is down to your specifics. And so book in a free consultation. It'll be pretty quick to understand what your offerings will be. Again, from an overseas perspective, does the credit rating apply to potential buyers from Zimbabwe? We have a lot of clients in Zimbabwe. We've traveled to Harare from our Johannesburg office pretty extensively. We've done a lot of business there over the years. So we do have many clients that have bought from there with mortgages. And so, Sophia, you've obviously dealt with those. And again, it would be good to book in a meeting. If you want to add anything to that, Sophia.
Yeah, no, absolutely. No, where often we go to, Joseph, Mews and I, we've done trips to Zimbabwe often, and we have a number of clients who are based there, and certainly there are lenders who have an appetite for it. So there's certainly something we can assist with in short.
Perfect, thank you. I think just another question on registering a UK company in the UK and using it as an investment vehicle. A lot of buyers within the UK do this, and a lot of buyers from overseas do this. And yeah, obviously, again, the rates are pretty similar in terms of what you'll be offered in terms of LTVs and rates. Again, we would probably advise you based on your circumstances as to what the best solution for you is. And we also work with a company that sets up these companies very quickly in 24 to 48 hours. So again, that's an introduction that we can make. Did you want to answer this?
Yeah. A couple of other questions, maybe non-mortgage related. This is someone asking, what happens to your 20% deposit? So you're buying off plan, you're exchanging on 20%. What happens if you're unable to complete? Can the flat be sold to a new buyer? We have had a few instances actually where that's happened. So someone's put down their 20% and their circumstances have changed. They're not able to get a mortgage. And our responsibility is to our investor, but it's also to the developer, because we work hand in hand with the developer. So we're not an agent looking at short term and just looking for a commission. A lot of agents, once they've sold you the apartment, the property, there's nothing in it for them. They're not really there to help. We are. And in the cases that we're dealing with so far at the moment, there's a couple. We need as much notice as possible, but we've managed to sell on that apartment, obviously closer to completion, to an incoming buyer. So yeah, we'll always help. We'll look at everything on a case-by-case basis, but yeah, always happy to get involved and make sure that we're looking after you as our client and the developer, because the developer is expecting you, and contractually you are obliged to complete. But yeah, we'll always help there. 20%, I think that's covered most of the mortgage options. I think I saw something that flashed up earlier on about buying off plan as to compared to buying something a little bit older. Obviously you can do that. Buying off plan or something newer is better. You've got the latest energy ratings, the EPC ratings. It's got all the new facilities. The one I mentioned in Birmingham, the Settle one, it's got roof gardens, it's got a co-working space. It's got those kind of modern amenities that the modern tenant wants. Having said that, Johnny and I visited another development just before the webinar, the Colmore on St Paul's Square, which is just coming up for completion, and that's partly listed. So we've kept a lot of the original features. It's only 16 apartments, very sort of hog and pole kitchens, very upmarket, very different. So we do have various options, not just your typical sort of new build, although that is super popular. I think that's it. Have we done through most of the questions? I'll hand you back to Johnny for the last couple of slides, I think.
Yeah, I mean, I think there's a few more that are around the sales sort of process and that side of things. We've got a question about, can the purchase of a sale property be done independent of an agent? Yeah, I mean, we work directly with the developer, so we're not working specifically as an agent. Our commitment is with the developer, so it's an exclusive relationship with that developer. So it is slightly different from working with an actual agent that is obviously taking a commission their side from the service that they offer you. But again, we can explain that in further detail on a private call. So yeah, and that leads me on, I guess. Look, Hitton and Sphere have been great, and thank you so much for both of you your help. And again, we've got another slide which will basically allow you to decide whether you want to book in a one-on-one conversation with either one of our consultants overseas or in the UK for Andrew, or then also for Hitton and Sophia. So thank you all for joining. Thank you to Hitton and Sophia, and yeah, look forward to hearing